Well, I don't think it really does, except for the predictability factor. I mean, if Powell is more interested in a Volcker-esque kind of tenure, then he's not achieving that. There have been so many false messages throughout this last year. I'm not even thinking about raising rates. 75 basis points is off the table, and a couple weeks later we get it. This recent disinflationary comments that he made, and then now we're back to, those jobs numbers look pretty strong. Maybe we need to raise more. And the market cares more about predictability than they do about the actual rate level, because we know we're closer to the end than we were a year ago. So I think that's why you're seeing the NASDAQ hold up pretty well, because I think they're interested in seeing the Fed give us a consistent message. This comment about being data dependent, they're looking at backward-looking data instead of forward-looking. And that's, I think, one of the reasons they have to keep digging themselves out of the hole.
Why do you think, Nancy, that the NASDAQ is holding up a little bit better? I am curious about some of that differentiation we're seeing today.
Well, I think it depends on which part of the NASDAQ you're talking about. The names that we own are producing really strong earnings growth. They've raised guidance on margins in some cases and on earnings. So reliable growers in a slowing economic environment, which is what we're getting. I mean, whether it's a hard landing recession, we think we're going into a recession. And in that case, you can still make money in stocks, but you need to be in the right segment. So the cyclicals do well in this particular environment, and that's where we're focused.
Right.
And so the NASDAQ technology names that have held up really nicely. Broadcom's report was incredible. That's one of our largest holdings. Those are the places where we're redirecting
so
capital.
Now it's not like 2020. Now if you see NASDAQ leading the way, you can go, well, then the slow growth trade is the growers in a no growth environment trade. Peter, before I get to you, let's just hit the results of this 10-year, because the yields are creeping back up towards 4% in its wake. Rick Santelli joining us. Rick, what's the deal?
Well, it was a horrible pricing. Now, do keep in mind that these are 9-year, 11-month. It's a reopening. That should make some difference. Sometimes it makes it a little easier to move the paper. But in this instance, the yield was 3.985 at the auction. But the when issued market was trading nearly 3 basis points lower, 3.958. So it tailed almost 3 basis points. Everything else is almost meaningless. When you have a lower yield, you have a higher price. When you have a higher yield, as in this case, you have a lower price. If you're auctioning securities, you don't want a lower price. So most of the other metrics were near 10 auction averages, but the pricing gives it a D as in dog. And as you look at the chart, you could clearly see the market voiced its opinion almost immediately on the results of the auction, as yields are moving a bit closer to 4%. And by the way, if everything is as hawkish as they say and the Fed has their thumb on the pulse, why are 10-year notes so far behind? Why is the curve so inverted? We still can't even hold 4%. And if you open the chart up, we're nowhere really near that 4.25, which is the fall high yield close, which 2s and 3s have circumvented. But the rest of the curve is still below.